Hey everybody, welcome to the channel. My name's Justin Von Meigen. My goal is to help you pass your life and health insurance exam on the first try. Today in this video, I'm going to be covering interest-sensitive whole life insurance and comparing it a little bit to traditional whole life. So interest-sensitive whole life insurance is permanent lifetime coverage, just like traditional whole life. The biggest difference lies in how fast the cash value could grow or how slow it could grow. The cash value growth is based on market conditions, the interest rates in the market conditions at that time. So if the market's doing really well and interest rates are up, then the policy could earn more. And if the interest rates are lower, then the policy could earn less. So it accumulates cash value, just like a regular whole life policy, a traditional whole life. It has a guaranteed death benefit, and it has a guaranteed minimum interest rate that it can earn. It does not have a steady growth rate. So traditional whole life has a steady growth rate. Typically, it's like a fixed interest rate that the traditional whole life cash value will grow at. The interest sensitive whole life can fluctuate up or down based on market conditions. Okay. This may also be known as current assumption whole life. So where it has lifetime coverage, but flexible elements that are influenced by current interest rates. I'm just checking out my notes here, guys. If you see me looking, I'm looking at the notes that I took. If you'd like a copy of a study guide to learn more about life insurance policies, a free study guide, just email me right there, jve@thejve.com. And just email if you put free study guide in the description, in the subject, and I will email you a free study guide. And you can also, in the comments in the description of the video, check out some other products that we have to help you guys, but you can get that study guide for free. So the premiums are not flexible, so they're fixed, and the death benefit is fixed. So the premiums and the death benefit are fixed on interest sensitive or current assumption whole life. There is a potential for faster growth on the interest sensitive whole life, but there's also a potential for slower growth. All right. You can take loans from the cash value with interest sensitive whole life, just as you can with regular traditional whole life. And the death benefit is paid tax free. So some of the pros to interest sensitive whole life is it responds quickly to market fluctuations. So if the market's doing really, really well, and the interest sensitive whole life will start to accumulate cash value faster, whereas a traditional whole life is not going to change. It's going to stay the same. You get higher returns in a high interest environment, and there's no risk of loss in the interest sensitive whole life. So they can't lose money. There's a minimum set. So there's it does grow more slowly in a low interest rate environment, and there's really no investment flexibility. So that's basically the summary there of an interest-sensitive whole life versus traditional whole life. If you have any questions, just email me at the description, at the email right here on the video, or it's in the description of the video as well. You can also obtain that free study guide. Just reach out to me. My goal is to help you guys pass your life and health insurance exam on the first try. Thank you.